Thank you very much for joining us. It's a great pleasure to have with us today Sanjay Guglani, Chief Investment Officer of Silverdale Capital based in Singapore. Welcome.
Thank you.
Great to have you on the program and learn from you. The topic for today is really exploring the differences between investing in developed versus emerging markets. And you've had a vast career and experience in emerging markets, and really keen to get from you an inside view of how a successful investor in emerging markets operates and what are the lessons learned. Before we get to all of that, tell us a bit about your background and your career so far.
I started my career way back in 1990 as a portfolio manager. Moved on to handle India's largest cash future R book. Did private equities, got the first foreign investment into Indian last mile broadband. That was in 1998. Thereafter I moved to London, where I had two key businesses. One was in terms of getting foreign investors into South Asian economies, specifically India. We got more than $4 billion worth of investments, and we were ranked among the top 3 in the world in terms of convertibles and GDRs for Indian companies. We also had a joint venture with Goldman Sachs in Philippines. We had a joint venture with Lehman Brothers in Indonesia, Morgan Stanley, and so on and so forth. And then we had 2008. So I had to get hold of those assets because Lehman got bankrupt. We need to clean the assets, and we were successful in terms of selling those assets, etc. out there. And we decided that we want to make our investor base more broad-based. So currently we have two key businesses. One is in terms of advisory. So we advise a lot of private wealth managers, banks, pension funds, etc. out there. And other thing is that, of course, we run about a handful of funds, both in terms of fixed income as well as in terms of equity. But yeah, our bias is in terms of emerging markets because we see value there.
Now, if we focus on equities and, of course, equity investors coming from, let's say, the US or Europe into the emerging markets anywhere in the world, but maybe particularly here in Asia, sometimes the mindset tends to be the same and applying the same approach to various geographies. So help us understand how do some of these investment principles in developing markets differ from those in the developed markets?
Oh, they're vastly different. They need to be customized, so to say. Let's begin from the first premise. Risk and reward don't go together. Else, gamblers will be the richest people on the world. Take a step back. The classic Buffettologies in terms of, good business means good investment doesn't hold true. You buy and hold doesn't hold true. And we need to understand why. Once we understand why, we know how to adapt it. One of the key success factors for an entrepreneur to make monies and be successful in emerging markets is how well he can manage the barriers. Tackling the barriers is the key competency, be it in terms of expensive licensing, be it in terms of red tapeism, be it in terms of getting funding, wherein most of the financial institutions will be cahoots with the political parties. So it's very, very critical to understand whom you know, how do you know. So you would have, very strong relationship which will make an entrepreneur successful. And these very relationship, the incumbents, which will make others unsuccessful. So those subtleties are very, very important to understand. Let me give an example to illustrate this point. A Lebanese immigrant goes to Mexico, bids for telecom. His bid is not the highest, but he still gets the telecom license for Mexico, becomes a monopoly. There is an antitrust case filed against it, and he uses 1857 law saying that this particular law should not apply to him. Why? Because in 1857 there was a law which, in case it was not humanitarian, that could be avoided being applied. Now, what is antitrust to do with not applying to them? But the truth is this particular gentleman is called Carlos Slim, is one of the wealthiest person in the world today. But if he tries the same stunt in US, where he took over, I think, Comp USA, he fails miserably. Same thing we see in other countries, like for example, the Ambani family in India. There are two raw materials, just to take a background, DMT and PTA. Both are two alternate ways to manufacture polyester. Why should there be 400% custom duty on DMT, my apologies, on PTA and not on DMT? We don't know. But yes, we do know that the Reliance was manufacturing PTA. The rest is history. So the key thing is that to be able to manage the external environment is critically important. So as investors, when I invest into emerging markets, it's very important for me to understand the socio-political system besides the industrial environment.
And let's perhaps talk then about, given the backdrop that you described, given these differences, practically speaking, then how do you seek to benefit from investing in emerging markets? Can you give us some examples of that?
Yeah, the way to look across is to look at the whole gamut of things. If in Singapore I was to set up a factory, the last thing I would worry about is power, about roads, about logistics. But if I have to put the factory in Indonesia or even India, my biggest concern would be how would I get the raw material? How would the raw material move? From where would I get the funding? So these are things which are very, very important. That is where the buy and hold principle of the developed world has to be used very, very carefully. So for example, a company is very successful, fantastic track record, doing very, very well. They want to increase the capacity, and in emerging markets, don't be surprised, they increase the capacity by 100%. Would I invest into the company? Look, the company is successful, doing very, very well, have orders on hand, good reputation, everything. In the Western world, yes, that's the time to invest because once the factory is up and running, fabulous. But in emerging markets, the answer is no. I'm not a private equity investor. I run open-ended funds. My investor require returns, consistent returns, and continuously returns across out there. So I will watch. I'll watch, for example, how the funds closure happen. I'll watch, for example, how the environmental clearances come. I'll watch how the raw materials get tied up. So I will have to wait for the factories to get up and running before I would invest. One of the largest and biggest risks which we run as emerging market fund managers is the construction risk. So I need to be correct in terms of when I want to invest. There is a large number of slippages, huge amount of failures, huge amount of delays. So I can't take the risk just because of the track record that he will deliver. Yes, obvious question is, look, Sanjay, in that case, you will lose 20% upside. I say, fine, so be it. If the capacity is going by 100%, the profit should go by 100%, the EPS should be more than 100%, and if the share price is going to go by more than 100%, if I lose out on the first 20%, it's good business, it's good investment.
Now, you mentioned earlier your expertise across the capital structure, across various types of asset classes. Give us a sense how that helps you in emerging markets.
Oh, that's the holy grail for us. The key thing is not to have a blinkered view. Local currency, long only equity, doesn't work. Doesn't work because of three key reasons. First is, the emerging market currencies always depreciate. And they have to depreciate. It's economics 101. Interest rate parity. I have an inflation of 8-9% in the developing countries, whether it's Indonesia or India, and I have 1 to 2% in the Europe or in the US, the currency has to depreciate by 5 to 6%. So if I were to talk about pure local currency exposure, I have to be cognizant of those facts. I have to also be cognizant of the facts that in terms of emerging markets, the usual accounting norms do not apply or apply differently. There's a huge gap between the local gaps and the IFRS, for instance. If you ask a single message which I would like to convey, that is in terms of understanding the cash flow. Mind you, not funds flow, cash flow. Yes, you may say that, look, cash flow is very simple, use Bloomberg, you get the cash flow. The answer is Bloomberg is always wrong. It's always wrong because it's not meant for the purpose for which we are looking at. I'll give one basic principle behind to explain that. Under IFRS, consolidation of accounts is just done based on ownership. I'm a British company with an Indian subsidiary. So how do I do consolidation? Indian liabilities, English liabilities, total liabilities. Indian cash, British cash, total cash. Indian cash, British cash, pure fiction. Why? Because if in England I want to pay some monies, can I take money from India? The answer is no. So if you can't take the money from India, then the cash doesn't belong to you. You may look at the Vedanta PLC balance sheet in London and say, look, hold on, they have $3 billion lying in one company called Hindustan Zinc in India. So they have not been able to take £1 sterling out. You're talking about $3 billion being taken out? So you need to understand how the cash flow actually works. So if I were to allow Bloomberg to run my funds, then all the ratios which I calculate, whether the quick ratio, current ratio, debt to equity ratio, all will always be wrong. This cash flow is the key. Companies get bankrupt not because they're not profitable. Companies get bankrupt because they don't have cash to pay. And in the emerging markets, access to cash is not easy, and we need to be very, very sure about those things.
Give us a sense, how do you then get comfortable with that? What do you look for? As you say, we need to be very sure about it. So what do you look to in the financial statements or then beyond financial statements to gain that comfort?
Both. The first, what we call internally hygiene, is of course look at the financial statement, but not at the funds flow, but at the cash flow. What do I mean by that? Again, 2 points. First is understand the structure itself. Is the cash fungible? Who owns the subsidiary? How the cash can go up and down? You need to have very, very clarity across all this. Understand the covenants, understand the principles. Once you understand that gamut of things, then understand in terms of what are the motivations. Understand, how the waterfall will actually happen. Let me take a step to, and I'll come back to this portion again. The important thing is to understand the cash flow and understand the waterfall. Both are critically important. And therefore, you can, for instance, get equity-like returns without equity-like risk. And that's something which can make a person a successful fund manager. Okay, let me now elaborate this to further explain to you. Let's talk about real estate companies. Something which everybody claims to understand. Okay, but if you look in terms of real estate company in India and a real estate company in China, you understand and appreciate that the Indian company and the Indian GAAP would typically account for its revenue based on percentage of completion. Okay. So if the project is, say for example, 40% complete, he may recognize, say, 30% or 25% as revenue. A Chinese company is not allowed to recognize that as a revenue. So he also did say 40% project completion, but he recognized zero revenue. Now on the Bloomberg, Indian company looks fantastic and the Chinese company doesn't look so good. But the truth is that both companies don't have cash. So if I go and buy the equity of Indian company and then find the equity price coming down by 70%, and I say, look, something is going wrong. Nothing is going wrong. I need to do homework. So how would we do in that case? Well, these companies would be borrowing something about 18%, 20% interest per annum. Right? In most of these cases, we are able to invest on a secure basis. So there are certain assets which are securitized for purpose of raising the loans at 20%. I'm happy to put the money there. So I'm getting equity-like returns without equity-like risk. To take to the point where I left across out there, so not only we need to know cash flow, we need to know waterfall. What is equity? It's a residue after paying the bondholders and the taxes, etc. out there, right? So I'm getting same equity type return with a cushion underneath. So these are the things which make a difference, and also because of the fact that it's not easy to raise monies because the fund constraint is always there. The economies are growing very fast; they require more monies. This subtleness in terms of the structures and inefficiencies can be exploited to generate alpha.
So let me just see if I got this right. So in a sense, let's say an investor based in New York doing some quantitative screening on companies in Asia, equities, looking for these nice statistically cheap financial ratios, gravitating towards owning the equity of those companies. That is, first of all, wrong because the financial statements do not reflect economics accurately. And then secondly, why just consider the equity? If you like this company, maybe you should look into the capital structure and seeing whether you can make your equity-like returns by being open-minded about where do you invest, what type of security.
Perfectly right. Absolutely right. And let me give you two adjuncts to it. The first one is that there are huge number of companies which are quoting it substantially below the book value. I'm talking about 60% discount to book value. So according to the value investment, they're dirt cheap. Come on, And many of these companies are holding company which are holding listed equity. So you can say, look, there's some flippy floppy things we do not know the assets value. I say, hold on, they own equities underneath. So, but if you were to invest into this company, and I give one example like the Nebula investments or Pilani investment of the Birla Group, most of the groups across out there, you realize that they have been quoting at 50% of book value from last 20 years. And they still continue to do it. And it's likely to continue to do it also. So you have to understand why. And the reason is partly historic, partly is the way the family thinks. Typically about 75% north of this company is held by the founders. Roughly about 10 to 15% of them is held by the trust. Roughly about 5 to 7% of them is held by the institutions, which are long-term investors, those who invested in the company 40 years ago, 50 years ago, and they're still holding those. So we're talking about liquidity of 2 to 3%. And they do not want liquidity to increase and change. It doesn't help them anyways. Historically, it was complete crazy to go there simply because it would have attracted wealth tax. It would have created a problem in terms of estate duties. They're not interested in that. So how would the unlocking of the value ever happen? So we can't even look into those parameters and talk about emerging markets. I'll give an example. Uh, India has one of the largest number of listed companies in the world, almost comparable to US, maybe a shade more. Almost 80% of those companies are highly traded. Almost half of the companies are not traded at all, almost in that maybe one trade, maximum two trades. So if you talk about the company as a sector, you need to understand why. In 1970s, there was a rule in India that if the company is not listed, you have to pay a wealth tax and duties at the time it was there. So they had to be listed. So they are listed. So we have to understand that value investment principles using statistical sieves would not work.
Now,
Yeah.
now you mentioned something very important that I think most people do not appreciate, just the importance of these family-controlled businesses across Asia, let's say, or certainly applies to other markets, emerging markets across the world. But help us understand just what implications that prevalence of family-controlled businesses has for your investment approach.
Yeah, that's very, very important. And just to put the facts on the table, almost half the companies are controlled by the founding members of the family. When you look at the family-controlled businesses, and to some extent, even the MNCs which control the companies in emerging markets. So for me, P&G India is a family controlled by P&G, and I'll explain in a few seconds why. Two things happen. One is that depending on the family, there could be corporate governance issues, whether by design or by default. Design means he's a malified intent, he does what he does. By default basically means if the Ambani family has two sons, the empire has to be broken into pieces. You have to understand that. You like me or hate me, that's the point of life. So that's first thing in terms of governance. Second thing is also to think how the family thinks. Think of family like a private equity investor. Think of them as strategic investors. They are not there to optimize the value of shareholders. They are there to optimize the value of business. And the difference between the two is this. They would take steps which may not be stock market friendly in the short term, but it would create wealth for the family and of course the other shareholders in a long term period. So what happens is that when you look at the company, you do understand at what stage they are as a family and as a company both. And then we give you a clue to where to go further. So if you see that the founders' sons have now studied abroad, 4 or 5 years experience, you can rest assured that they would be joining the family. If the business was earlier run by his father and his two brothers, why would they require 3 more siblings to join the business? So either the business has to be broken so that they can take it on different charter paths, or they to increase. So it's as good as a private equity person taking over a company and parachuting in the CEO. So we need to be careful about those parameters. So look, now the next generation has come. We should expect a spurt in terms of investment. Remember the previous talk. Construction risk is the biggest risk. So I'll be careful to see how this person now takes the company next stage.
And give us a sense about these family dynamics. You mentioned some succession issues that are important and perhaps more so now than they were 10, 20 years ago as the founders reach a certain age. And just help us perhaps by way of some examples talk about these family dynamics that and what investors really need to appreciate there.
I would put this way, every business has to be looked from the point of view of the business and from the point of view who is controlling it. So if PNG India has a subsidiary which is listed, and PNG US again puts one more subsidiary there, you need to be careful what they're trying to do. And invariably we have seen that when a foreign MNC puts a second company in an emerging country, which is 100% owned by them, that makes more profit in the medium to long term. So you have to understand the dynamics. It doesn't matter whether it's PNG from US or Suzuki from Japan. They're exactly the same dynamics in terms of things. So those are the things which you need to understand and appreciate. Coming to the more specifically in terms of the family dynamics, for the first two generations, it's only in terms of building and growing. It's only from third and fourth generation then it becomes more sustainable, where typically we see a professional management coming and the family becoming more of a family trust as an overseers stroke supervisors. As an investor, I need to see my risk appetite. Where do I want to be? If I'm with the first generation entrepreneur, I need to understand what he's doing, how is he doing. Go back to the first thing, how is managing the barriers. When I'm working with the second generation, then I need to know, say, hold on, his son is now joining the business, what is now doing with it? Is it going to break the family, break the business, or is it going to really make it to go to next orbit altogether? If you're working the third generation, I need to see how smooth is the transition from being family managed to controlled to being professionally managed and controlled. When the fourth generation is as good as the MNCs, that's because of ethics of the MNCs, whether it's Walmart, whether it's P&G, whether it's Reckitt Benckiser, in terms of how they treat the shareholders in emerging markets. Mind you, I didn't say minority shareholders. How they treat. And of course, the rules which are applicable to them in the developed world are not applicable to them in the emerging world. And that's all the difference.
And of course, the opportunity set is so vast in emerging markets. If we just look at Asia, or even just one country like India, the opportunity set, now the investable opportunity set may be something else, but just the amount of companies. And then we see, however, that the large companies remain quite stable. And we know the large companies, which ones they are in each one of these countries. But the small companies often do not scale successfully. They remain small. And when we think about compounders along the lines of a Warren Buffett, looking for these great businesses run by great managers, what would you say is the key reason then that they fail to scale and remain small? Does it have to do really often with these shareholder dynamics? Or also, as you mentioned, then I guess I'm trying to get at which companies, perhaps in your view, are the ones to focus on to identify the ones that have the ability to scale versus the ones that are sort of destined to remain small?
In one word, if I were to summarize or the takeaway for you, would be agility. How agile is the entrepreneur? The socio-economic environment, the political environment, the financial environment in these countries are nascent. The laws change frequently. The legal system is not robust. So the key thing which the entrepreneur needs to understand to succeed is his ability and his capabilities to be change with the environment. The reasons for larger amount of failures is basically the environment, internal and external. You are perfectly correct in pointing out that the internal dynamics does make difference when the entrepreneur has to rely on his next level of family or relationship or whatever it be. Also remember that he began because of his ability to manage the barriers. Those barriers were more personal. There was a network, that was the relationships, and those things erode. So if the entrepreneur doesn't change his color and try to go into becoming more and more upfront and clear and straightforward in corporate governance, he would fail. Good corporate governance is not a choice, it's a requirement. And as the companies grow, they have to understand and appreciate it. Unfortunately, there is a huge amount of hubris where they think what they did best was what can they take next year, which doesn't work. In the Carlos Slim example of trying to repeat the Mexico monopoly in US, it doesn't work. The Ambani family's success in India in terms of taking over Traveria of Europe doesn't work. So they have to understand and learn and unlearn and relearn in terms of the new dynamics. The second thing, these are all primarily internal. Other is external. In terms of external, the environment changes. Few decades ago, if you had license, you had basically a mint to print monies. Today, having license doesn't mean you're going to really make monies. You need to know how to use the license, be it in terms of power production or be it in terms of running telecom companies. So the environment changes. So somebody who is used to monopoly and the embedded inefficiencies in his system, that would kill him as we go further. So those are the both things out there. The key message is instability of the environment.
Let's perhaps talk about some of the differences within emerging markets, and if we want to just focus perhaps on Asia. Foreign investors tend to treat emerging markets all the same, or Asia, it's all the same. Help us understand what there needs to be appreciated in terms of the differences, and perhaps give some examples to just help us understand the fallacy of treating all of Asia or all of emerging markets one and the same.
Oh, it's a quite interesting topic. I always tell to people, remember, Africa is a continent, not a country. The Sudan and South Africa are as close to as you will have salt and sugar. Coming to even Asia in particular, each economy has its own nuances. And to give you one small point, for example, the single stock options in India are perhaps largest in the world, bigger than Chicago would. The index option in Korea are much, much bigger than New York Stock Exchange and Chicago Board. So you have to understand that these markets have their own nuances. So if I were to invest into India, for instance, and I'm afraid of the environment because, for example, a pending legislation which could change the dynamics of the company, easier way to manage that is future and options. Yes, given the fact that the capitalization of these countries is small in terms of stock market capitalization, I can deploy a huge amount of monies without having adverse impact on the prices. So if I want to put $20 million into a company in the emerging markets, the share price will go to the roof and still I wouldn't get the shares. Intelligent way, why didn't you write naked puts? Buy in forwards. Use algos. So my point is that once you understand the nature of the beast, then you are much, much better equipped. Execution can easily add 3 to 4 points on your performance as an equity fund. And that is huge. But if I try to use the same tools which are successful in Korea and in India into Indonesia, he says, bond? What is a bond? So you have to understand the subtleness of the market and know how to play around the game in Indonesia. You should understand how the retail market and the block market, as they call it, works there. If I go and invest into Mongolia, and this, look, I need to invest $20 million into Mongolia, Sir, you'll own up almost 50% of the floating stock. So you need to be sure about the underlying nuances to be able to actually make monies. And for making money is not when you buy. It is when you sell that counts.
Now, to tie that discussion into what we talked about earlier, the prevalence of family-controlled businesses across Asia, are there any interesting observations to make that have investment implications in terms of differences between families and how they run business, let's say in India versus Malaysia or Indonesia? How do you approach that with the experience of investing in these various markets when you come across a family-controlled company in India versus one in Indonesia? Are there any differences in your approach?
I would slightly, broad-base the definition of family-controlled. I would say it's majority-controlled. So we have Ricket Benchekar in India, who tries to buy up the minority stake at an unfair valuation. You have the SRs sitting in London trying to buy the SR Energy at not the best pricing. So it's a question of who owns the majority, which makes more difference. Does it change from country to country? The answer is to some extent yes, but not to a very significant extent. It's a question of who can get away with what. So if Suzuki can get away with taking almost 1/5 of the profit of the company in the form of royalty, they will ensure that the dividend paid to the shareholders is much lower, and as a majority holder, they would have taken as royalty. Could Suzuki have done the same thing what they done in India, for instance, in US? Absolutely no. There will be institutional investors, those up in arms. So it doesn't matter, in terms of, which family you're talking about. It's a question of the environment in terms of how much equity you hold. Having said that, the good news is this. If you look into the emerging markets in the Asian region, we're talking about the markets which are roughly between 40 to 60 years old. Most of them are fallen, somewhere 35, but around 45 years old. What it implies for a global investor is this. We are now looking at third generation coming into the play. So now you see families, those who are putting charitable trust. They're putting family trust. They're trying to professionalize the management of the companies. Those things have to be taken into cognizance when one invests into those companies. See, hungry man has no religion. But once your stomach is full, you can talk about ethics. So we need to understand and appreciate those dynamics to know which companies we should be backing as global investors.
Now, earlier you talked about the need to understand the structure of the company as an investor looking to figure out where the interesting points and whether in the capital structure or just which entity we're talking about. Often in Asia we come across listed entities, but then the family that controls the listed entity also has unlisted entities that they own. And is there perhaps a prevalence of such arrangements in certain countries versus others where these, let's say, privately listed entities are so important to consider when looking at the public entities? Is that perhaps a reflection of certain markets more than others across Asia?
Interestingly, our observation is slightly different from that. We do not see multiple companies in the same industry, out of which some are listed, some are not listed, directly competing with each other. I guess that is partly because of default. Please appreciate that the entrepreneur who started is a first generation entrepreneur. he's unlikely to have 5 companies to begin with. He began one company, floated the company, got some monies, and tried to go across out there. What we do see is the conglomerate effect. So we have a lot of conglomerates in terms of there have been a lot of group companies where the initial company tends to become more of like a holding company. But to have a company which is listed, unlisted, is seen more in terms of MNCs working in these emerging countries. So we will have the example which we took earlier, Procter & Gamble India, which is unlisted, and Procter & Gamble, which is listed. We have now Suzuki, which is listed. We have Suzuki, which is not listed. So we would have a lot of MNCs having those sort of businesses, which, of course, on the face of it, doesn't seem to be competing. But yes, in reality, they use the same channels, same distribution channels, same offices, same premises. It's very difficult to say, look, they are not competing. Taking a step further on this point, in terms of the regional dynamics, yes, we do see some sort of family conflicts more in countries like Indonesia, simply because they are more resource intensive. So what happens is that the family may put one resource into one company and then get something similar across out there. So sort of things we do see, but I don't see it's a huge issue in totality.
Could you share some examples of the investments you've been involved with and give us a sense of just how you think about the process of investing from when you generate the idea through assessing it, and how do you trade it to make the most out of these opportunities that you come across?
Sure. Let me give you 2 examples. Now one is in terms of the entire life cycle of how we spotted the company, how well it is there, and what do we think about it. Another is in terms of how do we get a better return with significantly lower return, risk involved there. This is a company called Jyoti Lab from India, which is the market leader in fabric whiteners and mosquito repellents. I'm not sure how many companies in the US would be doing the business. Very profitable business, growing very, very fast. We're talking about 20 to 30% growth per annum, at least later stage. Earlier it was almost 100%. EBITDA margin of 20% north. And it takes over a company called Henkel India, which incidentally was bleeding for almost 2 decades. So with all that, Henko and Prill and Fa brand names, they're complete disaster. So this takes over a company, almost 5 times its size, almost costing $1 billion. As you would imagine, the stock price get hammered by almost 70%. We like the company. We like the story. And we like it specifically because Henkel India, it was very strong in urban India. Jyoti was very strong in rural India. So in terms of overlap, they were minimal. And both could benefit from each other distribution reach. So we observed the company. We watched the company for almost 6 months. When it was all finalized, everything was fine, I said, okay, now we invest in the company. I think we bought first shares around 75, 80 rupees. And then we watched the company, the price went up to 80, 90, we bought more. Went to 100, we bought still more. It went to 120, we bought still more. And then we sold. And bought Henkel India. Why? Because Henkel India was to merge into Jyoti in the ratio of 4:1. And I make our profit of almost 20%. So I make 50% return on my initial investment, do an ARB into a Henkel India, and make 20% more return. And sit coolly out there. Let the merger commensurate. Once the merger is effective, I end up having again shares of Jyoti. So the share price at that time was almost 160.80. We sold the shares because the story was now basically done. By the time they got one of the most successful CEO of consumer goods company in India as their CEO. It was brilliant news for us. So okay, fine. There was a huge euphoria in the market. We said, thank you very much. You want my shares? Here you go. And when the subtleness came and people realized that the new CEO is not God. He has to do the merger. We know that merger synergy is talking about. We are talking about addressable market going by 10 times. So, but initial impact will be what? Initial impact will be he'll close down the factories. So we waited for the news to come out in the market. Look, he's closing the factories. And the share price took a dip. So thank you very much. I'm happy to buy. And then the news came after about 3-4 quarters that things are looking fine. They're cutting the cost. Henkel, which was making loss, started making 5, 10, 15% EBITDA profits over less than 2 years. So we booked some profits and now we're still holding the shares. The classic case of how do we do the whole game in terms of investing and being agile about the whole thing. This agility, as I told earlier, is a critical for success in emerging markets. If I buy and held, I would still make about 100% return. But because of doing ups and downs, I made almost twice that return. Now I'll give the example which is a little away from the mainstream. Look in Capita Mall REIT. It's the largest REIT, as you know, in Singapore. They have assets of almost $8 billion. Looks fantastic. Very stable, about 98-99% occupancy level. Their rental is increasing by 2 to 3% year on year. Come the QE tapering and the REIT go for a 6. We're happy to buy. We bought when the dividend yield on the REITs were close to 6%. And at 75-80% leverage, I'm making 20% return. For me, this is a lifetime opportunity. I don't think we would get this opportunity again in the next 30 to 40 years of my life. The opportunity of the fact that we can get money cheap. If I know what I'm doing, we should leverage it up. As I always tell internally, we are not paid to get good returns. Returns are not in my hand. We are paid to be good risk managers. If I can manage my risk very well, returns will come by default. So if I can make 22% in Capita Mall REIT, why should I invest in a tiny unlisted company somewhere out there?
And we're talking about that figure in
dollar
hard
terms.
currency.
Yes. So when I talk about it, I'm talking hard currency. Of course, when I talked about Jyoti, I was talking local currency.
You talked about agility, and I'm curious in terms of idea generation, then coming back to perhaps this notion that the foreign investors maybe do a lot of quantitative screening, looking for statistically cheap companies across Asia and get attracted to those. You described two quite different investment types. How do you, give us a sense, how do you generate ideas? What are your favorite sources of mispricings? How are you agile among the various types of opportunities?
I wish it was so simple, but then I'll be out of business. Okay, the key thing is to understand the environment, understand what it means. I'll give one example to explain what it means at a macro level, which people can relate to. In the 1970s and 80s, there was a company called Hero Cycles, extremely popular. Every Indian used to aspire to have a Hero Cycle. Come on, that's what we need to have. Then we had the 80s liberalization, the 90s, and then we had a company called Hero Honda. Hero Bicycle Group, as a group of course, not as a person. They tied up with Honda, and guess what? They became the world's largest producer of two-wheelers. Not only because of demand, which of course existed, everybody knew it existed, but because they are one of the highest mileage in the world per liter of petrol. Why? Petrol is very, very costly in India. So they became very successful. Then what? About a few years ago, 2-3 years ago, they broke away from the JV. because Honda thought they can do really well, but they want to concentrate there. Now, as an investor in Hero Honda, I have to look at the macro picture. Going forward, would Indians aspire to have two-wheelers, or would they aspire to have four-wheelers? Should I back Honda, or should I back Hero Honda, or now called Hero MotoCorp? And the answer is this. Hero MotoCorp is going aggressively in Africa. They have established more than 24 dealerships there. It's official, but not very well known. Why is not known? They will announce in month of April, May. Why would they announce April, May? Because the royalty agreement with Honda expires on 31st March 2014. So you need to understand the basic dynamics, how it works, and that will give you agility. So there's a macro point of view where you know what's moving where. I know two-wheelers will sell in India, but I'm looking at two-wheelers which have at least 150cc north, 250cc, 350cc. Those two-wheelers will sell. There's an aspirational value. The people, those who can afford it. So that's a macro. Coming to the micro portion of it, as the example which we took partly earlier, if a company is announcing a huge capacity expansion, that will immediately come on my radar screen. So worth looking into. Not worth investing, worth looking into. The good news is that many of these countries have a reasonably good reporting standards. Not the IFRS, but local. So at least we know what's happening on quarterly basis. So I know where the company stands, and once the construction risk is mitigated, I'm happy to invest. Last but not the least is that understanding the company on ground zero. My hobby is to visit companies and plants. I would have visited at least 1,000 companies. So when you visit a plant, you get a real feel of it. You understand who is controlling the plant, how the decisions are being made. Small things in terms of how the layouts, etc. are happening, how the people are behaving, interacting. Lots of insights. So there is no substitute for actually understanding and being on the ground zero. An emerging market is very, very, very important.
Just to pick up on what you mentioned about IFRS versus local GAAP, give us a sense, what is the difference there, and perhaps the language barriers as well? How do you read local GAAP, and give us a sense of just, in terms of the accounting, what's perhaps misunderstood or underappreciated by investors?
Couple of things there. Of course, local language is a barrier, but the good and not so good news is the fact that many of these countries were British colonies, so they have English quite prevalent in these economies. The settledness comes not only from the way the accounting is done, and then the best example of that would be in terms of fair value valuation. IFRS basically bases everything on fair value, while most of the local gaps would base it on the so-called market value, or more likely than not, historic value. So these are the basic, classic differences between the two. But above and beyond that is that accounting is important, but more important than accounting is the cash flow. So for me, beyond the point, doesn't matter what gaps you're talking about. You can call whatever asset you want to call. You can charge what depreciation you want, but you can't manipulate cash. As I always believe, depreciation is imagination of accountants. I believe this will depreciate in 10 years. You believe it's depreciate in 15 years. So be it. But the bottom line is this, that this asset is an asset. I'm more worried about how much cash is going to be generating, how the cash is going to be appropriated. There is where my investment opportunities arise.
So you're looking then into the cash flow statement or an IFRS basis, or the local GAAP cash flow that gets...
The beauty of cash flow is cash flow is cash flow. So once you talk about cash, then accounting doesn't matter. I'm talking hard cash. Okay. So when you're looking at cash, you are removing all the accounting entries from it. To give an example, I'm looking at the revenues from a particular factory or a company. I'm talking about how much is the actual sales. The depreciation you charge is irrelevant to me. Now you charge an IFRS, you charge a local GAAP is both irrelevant to me. How do you account for bad debts? Important to know, but not very interested. For me, this is the cash flow you generate. This is how you generate. For me, other things are good to know. But it's good to know. I cannot survive without knowing also. Why? The reason is this. Good, bad, ugly, 70% of the investors will be run by our friend Mr. Bloomberg. So I need to have a clear in terms of how they are looking at it. If the company doesn't have cash, and we know it's not looking great, I have two options. Throw the towel, run. Number two, it looks sexy on the books. Beautiful profits. Great buy because the brokerage houses in the world. Fine, I will still run. But I'm not throw the towel and run. I'll run certainly. That difference can make about 5 to 10 points difference.
And how do you then track and gain comfort with the cash picture, the cash flow of the company? Do you look at the, let's say, balance sheet cash at certain points in time and how that changes? Of course, appreciating again the structure and the waterfall that you talked about earlier, but just to gain a sense of how much cash there is in a company. We know about the Chinese reverse merger frauds, and people looked at cash. There was the kind of the balance sheet reported cash. They thought the cash was there, but it wasn't. So what can you actually do to figure out what cash is there and how it moves over time?
See, one of the very important things which we take care of it as investors is to understand not only the company specific, to also understand the peers group and the industry. I don't remember ever investing into a company because we like the company alone. Invariably, we'll look at the competitors. The competitors are making 12% profit, company is making 15% profit, fine. Company making 40% profit, not fine. So it's pure commonsensical to understand the nuances set out there. The most important thing to remember is what I call again the accountant's creation. And mind you, I'm also an accountant besides being a Sloan Fellow. When you talk about debtors, for me, it's non-existent. For me, it's no sales, period. In an emerging market, I take a sufficient risk. If my company is going to take a risk, I don't like it. So I don't like a company which has debtors days of 6 months, 2 years. Doesn't work. This doesn't work. I can give you half a dozen companies where the debtors are more than turnover of the company. Now, if that doesn't raise a red flag, I don't know what in the world can raise a red flag. And mind you, these companies are being audited by the big four firms, doing very, very, very well, fantastic profits. But I say, I don't understand the business. You're a service provider, IT outsourcing company, and your fixed assets are almost 50% of your turnover. Are you living in Taj Mahal? So my point is this: yes, you can look at the dynamics and say, look, growing very fast, 40% growth, one of the fastest growing company, acquired a company in US, blah, blah, blah. For me, I don't understand it. And we have a very simple principle. If in doubt, stay out, period. There's so many opportunities in the emerging markets, there's no point in taking extra risk by going into, gymnastics, about that, not required.
Now, Sanjay, you've been so generous with your time, and thank you for all the insights. Just to perhaps look to conclude and see, perhaps from your perspective, is there anything that we haven't discussed that you think is really important to your approach to emerging markets?
Thanks for the opportunity. I think you've covered basically the most of things. The message I would like to leave to the viewers is cash flow, cash flow, cash flow. Be sure about the cash flows. Companies get bankrupt not because they are profitable, because they don't have cash to pay. Be sure about the cash flows. Adjunct with the cash flow is the waterfall. Understand the waterfall. Blinkered view of long only local currency equity is not the best way to look at the emerging markets. If the person understands the cash flow and the waterfall, he should be able to capture the large portion of the waterfall without the commensurate risk. And for that, the most important thing is he needs to be agile. He needs to understand that the single biggest risk we run in emerging markets is enforcement risk. Be careful about those risks. Understand the cash flow again. Once you know cash flow, if he has cash, your 80% problem is solved. Then 20% problem is only his willingness to pay, his willingness to declare profits, his willingness to share his riches, his willingness to share the growth of the company, the companies he promotes. That willingness is to understand from the structure, from the composition of the shareholding, from the environment, from the legal framework.
On that note, Sanjay, thank you again so very much for your time and all the insights.
Thank you. It's my pleasure.